How the government crushed the middle class. The Indian middle class once formed the backbone of consumption, entrepreneurship, and tax revenue. In the past decade, policy decisions have steadily eroded its financial stability, disposable income, and upward mobility. The squeeze has come from multiple fronts. 1. No control on private education and hospitals. Private schools have increased fees far above inflation, with annual hikes of 8-12% being common. Private hospitals charge arbitrary rates for treatment, especially in emergencies, without transparent pricing or regulation. Lack of fee regulation means a middle-class household spends 25-40% of income on education and healthcare, leaving little for savings. 2. No meaningful income tax reform. Tax slabs have not been indexed to inflation, pushing more earners into higher tax brackets without real income growth. The 2.5 lakh rupees basic exemption limit has remained stagnant since 2014, despite prices rising by 50-60% in the same period. The so-called new regime offers lower rates but removes most deductions, hurting those with genuine expenses like home loans and insurance. 3. Capital gains tax burden. Long-term capital gains (LTCG) tax, previously exempt on equities, was imposed in 2018 at 10% without indexation. Short-term capital gains (STCG) tax remains at 15% for equities, with other assets taxed at slab rates, reducing returns for investors and discouraging savings in capital markets. 4. Cess and surcharges. The government increasingly relies on cess and surcharge collections that are not shared with states. Education cess, health cess, and various surcharges at 437% over base tax, disproportionately hitting middle-class professionals and salaried taxpayers. 5. GST plus high-income tax. Essential and semi-essential goods are taxed at 18% or 28% GST on top of already high personal income tax. Middle-class consumers face double taxation, first on income, then on spending. Items like electronics, home appliances, and even certain packaged foods attract luxury-level GST rates despite being everyday necessities. 6. State-level revenue grabs. State governments have increased stamp duty and registration fees on property transactions, making home ownership costlier. Road taxes on vehicles have risen sharply, often 10-15% of the vehicle's price, and are charged upfront. These costs directly hit middle-class aspirations for housing and mobility. 7. Tax on Voluntary Provident Fund. Interest on Voluntary Provident Fund (VPF) contributions exceeding 2.5 lakh rupees per year is now taxable. This penalized disciplined savers who prefer safe, long-term investments. 8. Tax on PF and NPS contributions above 7.5 lakh rupees. Employer contributions to Provident Fund and NPS above 7.5 lakh rupees per year are now taxable. Deductions under ATC, PF, ELSS, life insurance, NPS, ATCCD, ATD, health insurance, and home loan interest were the backbone of middle-class tax planning. Under the simplified new regime, most of these deductions are gone, increasing effective tax liability. The net effects: the average middle-class household now spends more than 60% of its income on non-negotiable expenses, education, healthcare, taxes, and basic housing, compared to about 40% a decade ago. Real disposable income growth is negligible once adjusted for inflation and new taxes. Savings rates among urban middle-class families have dropped from 12-15% in the early 2010s to below 5% today. Conclusion: the middle class has been systematically drained through high taxation, unchecked private sector profiteering, and removal of critical savings incentives. Instead of acting as a wealth-creating engine, this segment is being used as a dependable source of revenue without receiving proportionate public services or relief. If this trend continues, economic mobility for millions will stall, and the middle class as we know it will shrink into near extinction.